Well, hello and welcome back to Module 9 of the Series 65 and 66 class series presented by Series 7 Specialists. We're really glad to have you back and glad to be a partner in your success. So be sure and tell others about us. That's very, very important to us, and we really do appreciate you mentioning that to your licensing officer, your training officer, the folks you work with who may be needing a Series 65, 66 in the future. So in any event, when we left off on Module 8, we were on page 13 of the outline talking about required advisor disclosures. Now, I want to say one thing about advisors. And remember at the very first, we talked about separating the investment advisors from the broker-dealers. Totally separate entities, and we need to keep these straight, okay? In the case of advisors, if in doubt, disclose. If in doubt, disclose. I mean, that's a great way to get a correct answer where maybe you're not just really comfortable with what the answer set is, but one of them says disclose, the other three don't. Pick it if it has to do with advisors. The reason for that is there are all kinds of different entities and regulatory bodies and reporting agencies that require certain disclosures or provide certain safety nets for investors in the broker-dealer community. It's not that way with advisors. And so therefore, it's incumbent upon the advisor to disclose. If in doubt, disclose. That's the best thing to do, all right? And in fact, we start out here with one thing that for a broker-dealer, this first activity that the advisor has to disclose, for a broker-dealer is perfectly normal. I mean, they do it every single day. It's their business, for crying out loud. Okay? And that's to act as a principal or an agent in a securities transaction. That's what broker-dealers do. But investment advisors, they're a whole different story. Let me ask you this, okay? If I say that, I'm just going to pick on bonds because they're easy to use, okay? That this particular issuer, maturity, quality grade, what have you, if it's so good for this one customer, then why is it so bad for the other customer? That I would sell this guy's and have him buy the same thing. Or I would sell my own, have my customers buy that same thing. That look like a conflict of interest to you? Kind of double dealing? Yeah, so now it's not to say that it can't happen. In fact, let's stick with bonds. Let's say that one of my customers just called me up and said, Dan, I've got this great opportunity, but I'm going to need to raise $250,000 like real quick. And so I need for you to sell out some of my portfolio, and I need to withdraw that from my account at that your advisory firm manages. So I said, that's great. I tell you what though, okay, here's the deal. One of the things that I still like them, everything like that, but I'm really having trouble finding municipal bonds from this particular state with that particular maturity range. I'm going to have to sell some of those out of your account. Okay? I just brought on a customer that I spent 2 hours yesterday looking for some of those bonds. Would it be okay with you if I take those bonds and sell them to the other customer? The guy says, sure, no problem at all. I just need the money. If you think that it's one that ought to be sold. I said, well, you've got plenty that are in that range, that I would have to sell. He said, sure, that's fine. That's cool. All right, great. So then what I would do is I would call up my other customer and say, look, I've been looking for some particular bonds. One of my other customers called me up out of the blue, and he said, I need to raise some money. And he agreed to allow me to sell them out of his portfolio at a fair market value and buy them for your portfolio at a fair market value. Would this be okay with you? The guy says, well, yeah, it's fine with me. I don't care where they come from. All right. But in any event, what the advisor then has to do is to say, okay, let me get it in writing from the both of you. All right, that it's okay. Because I could get into a situation, now this one's straight up, but I could get into a situation where I have some double dealing here, and that's not good. So what I'm going to do, I'm going to get it in writing from both of you that you know that first of all, that I did not solicit both sides of the trade. That the seller came up to me and said, hey, I'm going to have to raise some money. Okay? The second thing is that I'm actually doing one portfolio to the other, and I'm going to disclose my compensation. And then what I'll do at the end of the year, I have to send out, because I got to disclose, got to send out this letter. Now most of my folks are going to look at the letter, they're saying, okay, over the course of the year, Dan did 3 crossing transactions, and he made a commission of $227. I say, what in the world is this all about? I don't care. Okay. But let me put these things into a little bit more perspective and make that last bullet point about the annual disclosure letter. Let me let it make sense, okay? You get the same letter, but it says over the course of the year that Dan did 12,482 crossing transactions, on which he made a commission of $1.37 million. Well, now, wait a minute. What's the guy doing? All of that is like from one client to another. You know, I'll tell you what the guy's doing. He's charging me a fee to manage my money, and then he's setting up a little cottage industry on the side where he takes my stuff and sells it to his other customer, probably then sells it again to another customer, probably then sells it again to another customer, and turns around and sells it again to me. But if the advisor is doing what he should, these little exceptional cases come up, fully justified, no problem with them, and you get the letter and say, well, I don't care. I've got more important things to do than worry about this. Okay. That's the whole idea behind that first bullet point. Disciplinary actions. They have to be disclosed. You don't have the disclosure forum like you do with broker-dealers and the CRD. All right, it's just not there. And so it's incumbent upon the investment advisor to come clean to his clients. I had a disciplinary procedure, so any court injunctions, regulatory actions, there is an exception, and that's SRO, or self-regulatory organization sanctions, for a fine exceeding $1,200 or $2,500. Those have to be disclosed. If it's below $2,500, then it doesn't. The reason for that cutoff is that $2,500 is the fine for a minor rules violation. And by minor, we're talking about the inspector comes into the office and sees that we have advertising and sales literature in the same manila folder in our file cabinet. He says, these need to be in separate folders. So we make a note of it, and then we lose the sticky note. Next year the guy comes back, he says, didn't I tell you last year that these need to be in separate file folders? Here, let me see your hand, I'm going to slap your wrist, there, and here's $2,500 fine. Okay, that's the kind of, people don't care about that stuff. It's a technical violation if it's under 25 or 2,500 or under. All right, so over 2,500, they do have to disclose. And of course, any suspensions or expulsions from self-regulatory organizations, those have to be disclosed because those are obviously serious violations. So all these have to be disclosed. And then referral fees. Referral fees are quite okay, but you gotta follow the procedure. Your solicitor is actually indirectly participating in the dispensing of that investment advice. Therefore, the solicitor has to be registered. Requires a written agreement between the advisor and the solicitor. So verbal is not okay, you gotta have it in writing. In fact, with the exception of advisory contracts at the federal level, I would just assume that everything has to be in writing. Okay? There's one other minor exception we'll talk about when we talk about the Uniform Securities Act. But the solicitor provides the client with the advisor brochure and the solicitor brochure. So disclose, disclose, disclose. Included in that is a disclosure that, look, prospective customer, you could actually go to the advisor and cut out the middleman. Now, you know what's going to happen is that the advisor is going to say, you know, I channel all my stuff through my solicitor, and probably not in that language, but really you need to talk to Bob because I would probably screw up the paperwork if you were to try to do it directly with me. Okay? Then you make the value judgment. Is it worth paying the solicitor or not? But it's disclosed so you can make an informed decision. And in fact, if you decide to go with that, then you sign the acknowledgement of the receipt of both of those brochures. All right, so anyway, that's required disclosures, but take it generic. If in doubt, disclose. That's a very good rule of thumb to have for your advisor questions. All right, so advertising. This is something where it's, again, kind of a little bit more unusual than what you've got over on the broker-dealer side. But you have something that's sent to one person. That's correspondence. That's a letter. Okay, good idea to keep those. If you send it to 2 or more people, then it becomes advertising. But if you send it to 10 or more people, then it's not only advertising, but it has a retention requirement. So if I send something, a promotional piece, to 7 people, it's advertising, but I really don't have to retain it. It'd be a great idea to do so, but I don't have to until I hit the 10 mark. Then it has a retention requirement. There's not a filing requirement with regard to advertising because there's nobody to file it with. Before FINRA and New York Stock Exchange regulation merged, it was the NASD, National Association of Securities Dealers. There's not a National Association of Investment Advisors, NAIA. In fact, as close as you get to NAIA is National Association of Intercollegiate Athletics. You go to file some advertising with them, they're going to say, this guy's crazy. I don't know what this is. They're going to trash it. The only place for you to do it is just to retain it there in your office in a file. So you do have to retain that. The standards for advertising, you will get tested on these. No testimonials. No testimonials. Again, this is one place where distinguishing between a broker-dealer and an investment advisor becomes very important. Because if I'm a broker-dealer, I can actually use a testimonial. I just have to disclose if I paid the guy. Okay? However, if I'm an investment advisor, just don't even go there. No testimonials. Okay? In the advertising. References to past performance have to give an honest picture. So you have to, at least the past 12 months, in all securities, all customers. Figure this one out, okay? The top 80% of our recommended list performed at a rate of 24% last year. Yeah, but what about the bottom 20%? You don't mention that 4 of them went totally bust. That by the time that you got out of 3 of them, that you'd lost 80% of the capital. So you see how you got to be honest about it. Our 17 most active traders did this. Yeah, but what about your 42 least active traders? You've got to provide that honest picture. Tell the whole thing. You can't imply or assure any type of future performance. You've heard it before. Past performance does not indicate future results. Yeah, there's a reason for that. There's no guarantee that you can replicate what you did in the past. In fact, I'll tell you right now, it's not going to be replicated. You might come close, but you're just not going to do it because conditions change daily. And if charts or graphs are used, limitations and difficulty in using them must be explained. Now for me, I'm a chart and graph kind of guy. And I read that and I thought, now, wait a minute, what's the deal here? I mean, I think that a chart or a graph is just, it's really great. Okay? And I can see more out of a chart than I can out of just numbers. But the thing is, let's just draw a chart here. And what we've got is that we have the number of stocks that performed greater than 10%, okay? The number of stocks that were 5 to 10%, and then less than 5%, and then these are a loss. Now that looks pretty good until we dollar weight it. When we dollar weight it, okay, what we find is that those are the ones that have a loss. Those are the ones that are less than 5%. Those are the ones that are 5 to 10. And those are the ones that are greater than 10. That's a different story now, isn't it? Yeah, because see, we're looking at them in different ways. And there are limitations that you've got when you use charts and graphs that you need to explain that this is just based on the raw number. It does not represent a dollar weighting. Dollar weighting, come back, disclose, disclose, disclose. Give them the full picture. All right. So anyway, it's, like I say, this looks great, but the thing is, we were somewhat lucky in that we had a bunch of positions, but we put very little money into them. In fact, right here, these that are totally different story. So like I say, explain the difficulties in using those. That's just one example of that. Free products and services that you offer, they have to be absolutely totally free. If there's an if there's a when, if there's a but, any type of word like that, there you go, there's your violation. So all of the following are allowed in advertising except we'll give you this service when you or if you, that's no service at all. Okay, that's not free at all. That's something that you have some type of obligation either before or after the fact. It's not free. Free means here you go, thank you very much. We appreciate the ability to give you this. And then disclose with preparer if it's not the investment advisor. Need I say my disclosure? No, I don't. The date of the first issue and non-current information that's used because times change, conditions change, things change. At the time of this taping, oil prices have gone down significantly. If I had taped this a year and a half ago, the dollar price, I'd say for oil, it'd be totally out of date today. And in fact, when you're watching this, oil prices may have gone back up significantly. And if I gave you the price of oil today, it would be out of date. Disclose that, because stuff does happen. Information gets out of date. Disclose it. Prohibited contractual and fee provisions. So what can I put, what can I not put in my contract? Contracts cannot be assigned without the client's written consent. Now, assigning a contract is really just pretty straightforward. Hey, my buddy Bob, okay? Look, I just got a new client. I am up to my eyeballs. I just don't have time for a new client. Can you take care of managing this for me, and I'll just take a little 20% override on it? Wait a minute. The customer talked to Bob already. He said, no, Bob, I don't want you to manage my money. I want Dan to manage my money for me. And now here I am farming it out to Bob. That's assigning my contract. That's prohibited. But there are other things that they might as well be an assignment. So what are some of these other things? These are very important because they'll be tested, okay? First of all, if I sell my business to Bob, see what's happening? Is now he's managing the money anyway. I've got to disclose that, and that, in fact, it's more than disclosure. That's in effect an assignment. I have to get the written consent of the customer to continue to do that, or Bob does. Okay, so if I assign that business, if I sell my business, if I merge with Bob, Bob winds up managing the money anyway. Okay, if I pledge a majority of the business's stock as collateral for a loan, then what's the deal? I've shopped the market. I can't find a buyer. And so what I'm going to do is that I'm going to move to Brazil anyway because I want to retire. So what I do is that I go out and say, I'm going to make all these improvements to my business, and I'll pledge the stock of my business as collateral for a loan. 90% loan to value. Okay, so there we go. And what do? I don't make any of the improvements. I take the money and move to Brazil. The bank forecloses, and what do? They sell it to Bob. Now, I doubt seriously that that's the thinking behind it, but you know what? It works for the test. And that's what we're here for, really, is to pass the test. So, in any event, those all might as well be assignments. So you have to get that written consent of the customer to continue to do business because somebody else is managing the money, or will or could. All right, so in any event. Now, there are certain provisions for a partnership. The reason I say that again is that if you see the word corporation in the description, these do not apply. It's a partnership, period. All right? If there's a majority interest change, now you can see that two ways. You can see 5 partners, 3 of them leave, set out on their own. 3 of them retire, 3, whatever. Or you can see it that there are 5 partners, and the guy that has the 30% and the guy that has the 40% interest, they leave and strike out on their own. Well, that's 70%. That's a majority interest. So whether percentage ownership or just, if they don't give it to you that, just assume it's an equal percentage and a majority of the number. If they change for whatever reason, I've got 5 partners, I bring in 7 more. That's majority interest change, assuming that, like I say, there are no percentage ownership, the numbers that are stated in the question. Then what I'll have to do, that might as well be an assignment. And so therefore I'm going to have to get that written consent from my customer to go ahead and continue to do the business. But what if one guy out of the 5 leaves and he's got a 20% interest? Well, what you do is you send out this nice little innocuous letter. I mean, you've seen stuff like this. You know, that's at Smith and Jones. We're sorry to say that after several years of good, faithful service, Mr. Jones has left our business. We wish him well in his new endeavors. You should expect to receive the same excellent coverage and benefits that you've received in the past. Essentially, nothing has changed except that Mr. Jones is now gone. That's it. Just inform them on a minority interest. Now, let's go back around, circle back around to the corporation. And let's assume that it's a publicly traded corporation. You know what? There's a minority interest that changes hands in that corporation every single day. You gonna send out a letter like that every single day? Well, that'd be silly. So corporations, these rules do not apply, just partnerships, okay? All right, and then fees are typically based on a percentage of assets under management or AUM you're likely to see. In fact, to the point that if there's nothing else stated, it's a good assumption that you've got a percentage of assets under management, that's the way that it's calculated. You can have fees that are based on performance, typically relative to an index or some independent measurement of what would be a reasonable performance in today's marketplace. That is allowed if the customer is an investment company or other institution. Remember back when we said that contract was like that thick. About that much of it is the table for if you do this, then that happens and we pay you that much. All right? Or if the customer is a wealthy individual defined as $750,000 invested with the advisor, or $1.5 million net worth, or officers, directors of the investment advisors who are individual clients, and they've been in the industry over 12 months, they know what the heck they're doing. All right, so and then performance-based fees are sometimes called fulcrum fees. And we've gone over our 20 minutes, so I'm going to go ahead and break it right here, even though we're getting a little bit close to the end of the section. You know what? Let's go ahead and finish this up, and then we'll be able to break right there at the start of the Uniform Securities Act. I hope you don't mind going just a couple minutes over our normal time frame. But discretion, you've got to have a written power of attorney, just like you have to have it in a broker-dealer environment. Investment advisors, though, may use discretion with a verbal authorization for 10 days. 10 days under the Uniform Securities Act. Not under federal law. If it's federal, it's got to be in writing from the get-go. But under state law, state-registered investors can use that 10-day period basically to get the things set up while the power of attorney comes in. Enforcement provisions, the SEC can suspend registration of an advisor for up to 12 months, and if it goes longer, then it's a permanent bar. Okay, so 12 months, and this is true like kind of generically, that 12 months is the longest suspension that you can have. And then decisions can be appealed to. Let's read this term backwards, okay? We want to appeal, so we take it to court for the United States District, and the reason we use the United States Court is because it's an SEC decision, which is a federal government agency. All right? Like I say, read those terms backwards, and they really do help out. 60 days to file the appeal. And then finally, bottom of page 15, that criminal penalties for violations of the law. $10,000 fine and or 5 years. That's under federal law, and we'll see the state law when we come back from Module 10. So again, thank you for bearing with me for just a few minutes over, but we'll come back with Module 10, pick up on the state law. Thanks again. See you in a little bit.